Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here to give you the market minutes for June 29th. This is for the week ending June 26th as we head into the last week of the calendar quarter here, and I appreciate you being with us. Please see our disclaimer for important information. So to begin this week's market comments, I think it's important to start with COVID-19 because this is really the driver behind some of this volatility that we've seen in the market this week. Basically to bring you up to speed through the end of the week of June 26th, there have been 9.5 million COVID-19 cases and just about 500,000 deaths. And then in the U.S., we've got 2.5 million cases and 125,000 deaths. On June 26th, on Friday, the U.S. reported a record number of new cases, which was 44,726. And prior to last week, the record high had been under 36. So, that's it's gaining a lot of attention. It's driving a lot of psychology in the market right now. And so, it's important to start off with that kind of data. And then we'll hit on some of the economic data, obviously some news in the stock market and some of the other investment markets, and kind of bring you up to speed on kind of the news you can use. So basically, last week in the stock market, the S&P 500 was down 2.9%. The Dow Jones was down 3.3%. The NASDAQ, which has been a real darling in the market, is down about 2%. And so obviously, we've had a rise in caseload in certain states, Texas, Florida, Arizona certainly being in that. But overall, we've had kind of investors that have decided to kind of take some chips off the table for the time being and kind of let the dust settle out on the current rise in COVID cases and see where we're going to be. A couple of market comments here. So tech sector is now 27% of the S&P 500, and there's not a whole lot of breadth in the market, if you will. There's the leadership is being driven by the tech companies that have a lot of cash. A lot of them are benefiting greatly by the shutdowns, stay-in-place orders, and things like that. What I'm finding is that you've got that part of the S&P 500 that's doing exceptionally well, and the rest of the S&P, which if you subtracted out the weight of those companies, would be probably doing about 10% lower. So year to date, just to bring you up to speed, the S&P 500 capitalization weighted index, again, that's weighted by the largest companies, and a lot of those large companies happen to be tech companies. That index is down about 6.9%. The Dow Jones is down about 12.3%. The Russell 2000 is down about 17.4%, and the Russell 2000 happens to have a lot of small companies in it. And we know from some earlier research done that the 40% of the companies in the Russell 2000 index are not even profitable. Looking globally, we've got the world index, the MSCI World Index, down about 8.5%. Europe is down about 14%. Asia is down about another 6.8%, more or less. And then looking at other markets, the bond market index, which happens to be the Barclays aggregate, which is a fairly long duration or maturity index, it's actually up about 6.1%, but both high yield and loans have been down quite a bit. People are really, really struggling to find yield in this low yielding market. But last week we saw a little bit of erosion in crude. We saw a little bit of erosion in the US dollar. I think we kind of expected that. And we also saw credit spreads begin to widen out again. And that's the difference between the yield of a risk-free asset, which would be like the 10-year US Treasury, and the yield on a higher yielding or higher risk corporate bond. Those began to spread out a little bit again. just a little bit of economic data. Last week we saw personal spending rebound in May. So as obviously we had some reopening activities. Personal consumption rose 8.2%. Income fell 4.2%, but that's coming off a month in which people received a lot of stimulus checks. In fact, people still have a lot of that stimulus money sitting on the sidelines and in bank accounts, we know. Savings rate is exceptionally high as a result, even though it fell slightly, but at 26%, that's just that's a moonshot number that we just never see. But we'll get data on manufacturing this week. We'll get obviously the June labor report on Friday, which is July 3rd in front of the July 4th weekend. And obviously we'll get some other high frequency data. So there are some green shoots. There's some things that are maybe kind of hitting a pause right now. I know that the TSA airline passenger tally that's going, the air passengers going through airports, that was actually up 12% last week versus the prior week. So some of the high frequency data is actually doing well. I mean, we know that household spending was up 8% in May, and on the weight of stimulus checks, which really boosted personal income in April by 10.5%. So again, kind of shaping that savings. All of this pent up liquidity that at some point, we'll be looking for a home, even though we know that coming out of a recession, and particularly out of prior pandemics, that you typically see much higher savings rates for a prolonged period of time. Anyway, so we've got that, and I think what last week is kind of driving home in terms of the psychology is that we're probably going to have a bit of a longer recovery than I think some people were hoping for as recently ago as 30 days. And really what that means is that even though markets rebounded a lot faster than the economy, and you could say that a 10-year treasury around 0.6% or 0.7% might justify higher price to earnings multiples in the market. There's still just an awful lot of optimism built into the market right now, and I think we are going to have more influence from news flow, certainly as much influence from that as we will from fundamentals coming down the pipe. Just looking through stock data, some other information here. So we know that for the S&P 500, the constituents, there's been an increase in cash and short-term investments. We've had a rise of almost 14% in the first quarter, and that's 3 times what we saw in the last 3 quarters. So companies are raising cash too. And I think when we get the second quarter data, that's going to rise even further. And we know that in addition, debt is, of course, very cheap now. The cost of capital raising for these companies is very cheap. And so we have seen a pretty meaningful rise in the cash position and debt balances and things like that for companies in the S&P as they're trying to kind of shore up their balance sheets to prepare themselves for this kind of long slog in this recovery. So there's been a rise in mutual fund redemption suspensions. We want to monitor that because we don't want, we certainly don't want this perception to build that there's liquidity choke points in the mutual fund market. That would be the last thing we want. And just another oddity of all of this is that the combined market cap of Square, Spotify, Tesla, Zoom, and Shopify just eclipsed the market capitalization of Berkshire Hathaway. So take that, folks. That comes to us from Sandy Leeds at the University of Texas. Really, I'm not going to spend much more time on the data. We certainly know that where the data is trending. And I think we're going to probably have some pause in some of the, I guess, improvement in the data, if you will, in the July numbers, and maybe that gets a little bit better in August. But it's still too fluid right now with some of the key states in this country kind of rolling back some of their expansion policies. But the second quarter economic growth rate, or I guess contraction rate, if you will, is kind of expected to be around 30 to 40% contraction. It is an improvement over what we saw, just several weeks ago. We're seeing a decline in home sales of existing homes, which is down about 27% in May, but nationally. But at the same time, we saw a price increase actually of about 2.3%. And then, with the interest rates, 10-year Treasury rates being really low, you would expect the average rate on a 30-year fixed rate mortgage, which is now 3.2%, you'd expect that to be a lot lower. That's it's kind of an interesting development. We've had a little bit of disconnect there in the real estate markets. Jobless claims about 1.5%. Again, that's kind of plateauing over the last several versus the last several weeks. We still have 30 million on continuing claims, so that's something that we'll have to continue to monitor. And obviously, we've got a little bit going on in the commodity market, and then on sentiment, we'll just have to continue to wait. Again, we'll just have to continue to monitor what's going on with COVID-19, the caseloads, and some of the municipal responses, state responses, which we know how much of an impact they can have on consumer behavior if you're locking people down. But I'm optimistic, frankly, that with getting masks on people and kind of urging some restraint in behavior, that we can turn the tide in some of these statistics and kind of get back to some of the positive data trends that we saw, because it certainly will have, as I mentioned before, especially in this presidential election year, it's going to have a lot of influence. That emotional factor for investors is going to have a very powerful influence, and I think just as much, if not more, than what the data shows itself. So hopefully that gives you a little bit of insight in this week, and obviously we welcome your questions and comments, and go ahead and close the presentation for this week. I hope you've enjoyed this, and obviously with our information right there, certainly invite you to reach out to me at your convenience, and hope you have a wonderful week, and we will be back at you with our next update after the 4th of July weekend. So y'all be safe, y'all have fun, and cherish the time with your families and loved ones. Take care.